I think you should be able to see my screen now. Okay. Soft form. We already finished soft form, so we can try out Shadi. Shadi. So let's quickly go through the question and see what we are required to do. Shadi was incorporated on December 7, 2019 with an authorized share capital of 2.5 million. It is engaged in general merchandise, commenced operation in July 1st, 2020, sorry. So the accounting year end is November 30 every year, so you can clock that. The statement of profit or loss of the company has been reviewed to the following. So we have year ended November 2021, period ended is November 30, 2020. Can somebody tell me why November 30, 2020 is period ended and not year ended like 2021? So I would like somebody to tell me the reason why we have year ended in one and period ended in the second one.
Because the first one is not up to 12 calendar months.
All right, thank you very much. That's just it. Because the period ended is not up to 12 calendar months. So we have the gross turnover, we have the expenses, additional information, and we have the what? Capital expenditure acquired. Compute the company income tax liability for the relevant years of assessment or the relevant assessment years. All right, so that's quite simple. First, we need to do the capital allowance, right? Let's do capital allowance. Yeah. Computation of capital allowance for, we have just 2 years there. So which year of assessment would it be? We have 2020 and 2021. So which year of assessment are we computing for? Guys. Nobody's speaking. No.
2021 and 2022 year of assessment.
Thank you. Okay. So we are going to have the year of assessment. The year of assessment. How many assets do we have? Plants, furniture, F and F, motor, right? Then we have total. Okay, for the initial allowance, let's put it in percentage. And also in percentage. So for plants, we have 50-25, right? 50-25. Furniture is 25, 20. F and F is 25, 20. Motor is 50, 25. Correct me if I'm wrong, please. So we have the Naira sign. So the first year of assessment, remember that this company is a new company, right? It's a new company. So what will be the first year of assessment? Using commencement rule. We have from the date of commencement to the end of the first accounting period. We know that this year of assessment is 2021, as we have stated above, right? But the accounting period is before the date of commencement, 1st of July 2020, right? First, I don't even know how to write it down. It's no right nonsense. Um, 2022, 30 November 2020. Yeah, I think this should be it. So first, date of commencement to the end of the first accounting period. Now let's go back to those assets now. Which of these assets did they buy within the time frame?
Yes.
They got,
There's plant.
so we have costs. Plant, they got plant 2,480. Which one again? Furniture,
Yes,
right?
furniture.
Then
Pictures and fittings.
this is- do motor fall under this date?
Yes. Motor, no ma'am.
Yeah?
Pictures and fittings.
Yeah. So motor does not fall
Motor does
under.
not stop.
So then we have our initial allowance. Initial allowance. This one is not supposed to be here. It's supposed to be here. Initial allowance of plant equals to what? 50% of this figure. And for this one is 25% of this figure. This one is also 25% of this figure. This is 0. We add up all the initial allowance and there we have it. So for annual allowance, annual allowance equals to the cost minus initial allowance multiplied by 25%, right? Let's put a minus there. Okay. This one cannot be true. Sorry guys, give me a second.
You are muted in case. No, ma, you're muted.
Hey, I'm so sorry. I was on a call and I didn't want you to disturb the class. Okay, Fatima, you have a question? Do you have a question?
Oh, yes, ma, I have a question.
Okay.
Repair and maintenance. There is cost of plant and equipment and cost of furniture and fitting. What in 2020? That's what you include it.
I don't know what you are talking about. Repair and maintenance. Is it this question?
Yes, ma, this question.
Is it this question?
Yes, ma.
Okay. Repair and maintenance. Cost of new plants not captured in. Okay. Cost of furniture excluded. Okay. Okay. Yeah. Thank you so much for bringing my attention to this. So, which means we are going to be adding it to our costs. Plants. Plant is going to be equals to plus 125,000. Then what else? Furniture not included in PPE, Abi. So that's going to be plus 182,000. Okay. Thank you for bringing my attention to that. I did not check.
Please, I have a question.
Please go ahead and ask your question.
Good evening. Please, in regards the annual allowance, are we not doing workings for those periods? That's 2021. That's no, it's not up to a year.
No, okay, that's true. We are supposed to prorate the annual
For
allowance.
plant,
How many months
furniture,
do we have in?
and FF, and furnitures and fitting. Those three assets.
How many months do we have in July to November? July, August, September, October,
5
November. That's
months.
5, right?
Yes.
So that means we are still going to prorate more. Multiplied by 5/12. Okay. It shows that you guys are actually concentrating. Thank you. Okay. I think this should be it. So we are going to be utilizing investment allowance because as at this particular time we still have investment allowance. It has not been scrapped. I think it was financial 2023 that scrapped also.
Please, I missed
So
this part for sorry for cutting you in. This furniture, okay, yes, furniture, the cost. The question is 520. How we got this 702? Is it 702? I think I
so
missed
the
that part. Okay.
additional information one, repairs and maintenance. So in that additional information, they told us that we have cost of new plants not captured in PPE, which means they bought plants. Instead of them to go and put it in assets, they came to put it in expenses under repair and maintenance. So it's our own job to remove it from expenses and add it to the cost of the assets, which is one that is under plants here. So we had
So
it.
that's 520 plus 125, have we?
Yes, 125. So for furniture, cost of furniture excluded in PPE That's 182,000. That's why we have our 520,000 plus 182,000. Do you understand it now?
Okay, so it's not the 125 we're picking.
This 125 is for plants.
Okay. Okay.
182
Okay.
is for furniture.
Oh, okay. So we have to do for both.
Yes, because they are two
Okay.
different assets.
Okay.
So when
Thank
we are disallowing expenses, we disallow it from the expense, we add it back. Okay, so now investment allowance. How many percent is investment allowance?
10%
10% of what?
of the cost. 10% of the cost.
Okay, remember that when we are doing investment allowance, it's going to be like we are not going to consider it when computing our tax written down value. I hope we remember that.
Yes, ma'am.
So this is our total allowance for the year. So tax written down value carried down. So we're going to be excluding this investment allowance exactly. So this should be it. Drag it across. So then we have the following year, 2022 year of assessment, which is now going to be 1st of what? December 2020 to 30 November 2021. Abi?
Please,
We have
sorry, the investment allowance was from from this 260, 500.
10% of costs. 10% of costs. You know, investment allowance was capped by Finance Act 2023. So the reason why I use it here is because as at this particular year of assessment, we still have investment allowance. You get. So, but when you see questions that cover 2023 year of assessment, 2024 year of assessment, then you are going to ignore investment allowance. You are not going to compute it. Do you get it?
2023 and above.
Yes. Okay. So I guess we have new assets here, which is the motto. Motto, how much? 2,400,000. Then we have the initial. Let me just copy this. Initial allowance 0 for others equals to 50% of the costs. Annual allowance, remember that when our first year is not up to 12 months, what do we do to our annual allowance formula for the following year? We use tax written down value divided by the remaining economic useful life. So in this instance, our formula for annual allowance will be equal to minus this divided by the economic useful life of plants will be 4 years, which is 100 divided by 25%, right? After the 4 years, we have used 1, remaining 3 years. And that's what we are going to have for plants. For furniture, useful life is 100 divided by 20%, which is 5 years. We've used 1 year, so we have 4 years left. Same thing with these fittings, equals to this one divided by 4. This one is new, so we do costs minus, sorry, plus, because we have brackets there. Initial allowance multiplied by 25%. Then we'll add it all up. Guys, I hope we are we are not, I don't expect us to be confused actually, because it's not the first time we'll do this. Hey. So tax written down value. Guys, that's it for the capital allowance. Any question? I hope we're not confused.
Hello, sorry, I'm just joining the class now.
Why did you come late?
Is it?
I said, why did you come late?
In fact, I slept for up. Oh, sorry.
Sorry.
This
I've not
2020.
done much. We are just doing capital allowance. We just want to start with the CIT.
I know this 2022 annual allowance. I don't really understand how you got these figures.
So we use the formula tax written down value divided by the remaining economic useful life.
Okay.
That's second formula. So this is your tax written down value. How do you get your economic useful life? You do 100 divided by the what? Annual allowance percentage. For plants, annual allowance percentage is 25%. So 100 divided by 25
Okay.
is going to be
That's
4.
all.
You get. So now,
Yes.
if you're looking at 4, we are going to consider this 2021 year of assessment as a whole year. So
Okay.
you do 4 minus 1 year. We have 3 years left. So this one is going to be the tax return value divided by 3 years.
Okay.
And that's what we did to the remaining asset as well, except motor, because this is the first year of motor and it's a complete 12 months.
So why are we using tax written down value divided by the
Because
number
if
of?
you stick to this formula,
Okay.
if you stick to this formula and you keep doing, let's say, this, it will give you the same figure, but at the end of year 4, you will still have money left.
Okay.
You have money left because this particular period is not up to 12 months.
Okay.
So the remaining months that is 5 months. That 7 months, the money for that 7 months will be left after 4 years.
Okay.
So to avoid that, you just consider this month as a whole year and divide the remaining money with the remaining useful life. So that 7 month money that would have been left has been prorated over the remaining 3 years.
Okay. Okay. So, but we can use the first annual allowance in the second year in another way around. This
I don't,
135.
I don't understand your question.
I mean, this annual allowance, this 135 plus,
Yes.
we can brought it down to this place now and continue like that.
No, we can't. That's why we are using the new formula.
Okay.
If you use it like that,
Yeah.
after 4 years, we will still have money left, which is not supposed to be.
Okay. So because the month is not up to 12 months, that is why we are using that.
Yes, we use 5 all over 12 year.
Okay.
So now,
Thank you.
in the following year, we are just going to take this remaining money divided by the number of years left.
Okay. Okay.
So after 4 years, then you will not have any money left. It's only the tenure that you're supposed to use that you have left.
Okay. Okay. Thank you.
You're welcome. All right, I think that's it for the capital allowance. Now let's compute the tax liability. Computation of tax liability.
Eddie,
Okay, so now let's do it simultaneously, right? So that I don't know what will save time. 2021, 2022. Now what's going to happen? I don't know if it's okay for us to just okay. So we have mirror. Okay. So what is the first thing that we do? Our net profits. This thing I think is past question. I think I saw it in the past question. It's not that hard, it's just bulky. Net profits. So net profit for 2021. Please don't forget, guys. 2021 is the one by your right hand side, by my own right hand side, sha. 2022 is the one. Okay. So please note where 2021 is. Maybe I should switch it. Let me switch it so we'll not be confused. Let's put 2022 here. 2021 here. Yeah, I think it's better that way. So that we'll not take wrong figure. So now net profit for 2022, we have 23764,840. For 2021, 14,064,300. So what do? We had this allowed expenses. So now to check out allowed expenses, let's go from the account itself. Salaries and wages, rent, transport, repairs, donation, utility, allowance for doubtful debt, bad debt, income tax provision. Guys, is it allowed or disallowed? Yeah, income tax provision.
Disallowable.
Allowable. Okay, any other opinion?
Disallowable. Disallow.
Disallowable. Okay. Any
Disallowable.
counter opinion?
It's allowed.
Disallowed.
Yes.
Okay, so why do you say it is allowed?
Yes, because you can make provision. So yes,
Okay.
the provision is not
So
allowed.
I think who supports Fatima? Who spoke last now? Is it Fatima that spoke last?
My name is Ifi.
If you sorry.
The screen is not showing. No.
I
Oh.
know I took it away from the Excel. Sorry, I wanted to see who was speaking. Who spoke first? Who was the first person that said it is disallowed?
I'm the one.
Okay, read one. So who supports read one? Who supports Ifi? Let us see if you guys will get followers.
I support read one. I said disallowed.
Okay, you said disallowed. I thought you said it
Yeah.
is allowed.
No,
All right.
no. I said disallowed because if you don't make a provision, the tax people will add it back.
It's not like we don't make provision, but sorry. It's not like we don't make provisions. No, we have provision for doubtful debt. Specific one is allowed, you know. For these particular expenses, when you are providing for income tax, it's more or less like you are removing your income tax from your expenses, which is not allowed. You are not allowed to remove your tax. Tax that you have not paid, you want to start removing it. Do you get? And this itself will reduce your taxable, your income taxable, like your chargeable income. If you allow me to remove the provision now, the tax that you will end up paying will reduce. Okay, so we disallow income tax provision. Okay, we have 425.
Hello, man.
Yes, I can hear you.
Please, sorry to take you back. The second formula you use in the computation of that capital allowance, that is applicable. That I believe that should be applicable when the capital allowance is prorated.
Yes, the second year after the proration.
Okay, that can only be used where the first year the annual allowance is prorated.
Yes. You can also use it in other situations to give you the same figure. But it is most importantly used when you prorate your first annual allowance. Okay. So printing, stationery, general expenses, legal and other professional fee, audit fees, bank charges, depreciation. Of course, depreciation is disallowed. Depreciation. I think some people did this and submitted to my DM. Somebody did it. I mean, two people said, not somebody. Two people actually did this question, and I just cannot remember what we discussed on it, but I think they really tried, Sha. Okay. So now let's move to the additional information. Repairs and maintenance. This one, I don't think I need to ask you about it. We already spoke about it. So we have the cost of plants, cost of plants, 0 for this year, 125 for this year. Then cost of furniture, 0, 182,000. Okay, donations. Donation to MD's church, is it allowed?
No.
No,
No.
madam, it's not allowed.
How about to XYZ club?
It's not allowed.
No, no.
Both are not allowed. Donation. 400,000. 250,000.
Sorry, please, though. For this donation, the
Yeah.
question we solved for Coco's Nigeria Limited. We chose Social Club and Royal Elite Club. How do we know the clubs that will disallow and the one that will allow?
Okay. So usually any club that is not, let's say for example, government club or something that is very important to the government, like for example, all these Boy Scouts, Red Cross, it is allowed. Places like Green, Cocoa Research, IITA, you donate to them, you donate to university, is allowed. Whether it's government institution, is allowed. But when you hear clubs that sound personal, Mama Oníkòkó club, kò sí nǹkan tó kàn wọ́n pẹ̀lú Mama Oníkòkó club o. The only allowed donations are usually the important ones. Donations that it is important for the club for the company to participate in. Whether you are helping the government or you are helping the industry in which the company falls. Do you get? But all this MD church is MD personal issue now. What concern company with MD church? Same thing with XYZ club. It is not my business if the owner of the company decides to join the club and you're not donating to the club. What concern authority with the owner of the company's club? Do you get? It's quite personal. I've been trying to look for the list of donation for you guys, but everybody have been asking said they have deleted it. So if not, you'd have gotten that list. I would have loved to get the list. I don't know why everybody have deleted the list on their phone. Sorry about that, but I'll keep searching until you write your exam. If God says I should see it, I will send it to your group. I will send it to your group by God's grace if I'm able to get it from anybody. Okay, so now let's continue. Legal and other professional charges. We have retainership fee, legal cost of acquiring new list, cost of defending. What is everybody calling me? Igba call lataro. Cost of. I don't understand all of this thing. Like, please give me 1 minute. Please, so sorry. Oh, I'm really sorry. Okay. So we are talking about the legal cost of new lease, defending traffic. Oh yeah, yeah, people, my people, my people. Which one is allowable? Which one is disallowed? Which one are we writing? Oh yeah, oh.
My legal cost of acquiring new lease is disallowed. Legal cost of defending tax appeal is disallowed.
All of them are disallowed.
All of them.
Yes, legal cost of traffic
my phone
offense.
is saying that you should defend what you said. So why did you say everything is disallowed? Oh yeah, oh.
Legal cost of defending traffic offense is more like a fine.
Yes,
Legal
actually.
cost of renewing a long-term lease is finance cost. Then legal cost of defending a tax appeal, I think, is when you are having issue with the tax authority. Maybe your assessment is wrong, or they find you because now is a cost, and they notice that maybe the assessment was under what you are supposed to pay, so they fine you and you pay the fine and still pay the complete assessment. I don't know.
How about retainership?
Retainership cost of legal cost of retainership fee is allowable deduction. So, but the legal cost of renewing a long lease, so that's capital in nature. So that is disallowed. So while the legal cost of defending tax appeal disallowed, the cost of defending traffic offense is also disallowable expenses.
So what everybody is saying is that the only allowable expenses in that place is the retainership fee. Is that what you guys are saying?
Yes, ma.
I'm trying to check my solution. I know I stopped this, but it's been a while. Don't touch it yet. Okay. Legal cost of new long-term lease. Okay, it's but retainership. I was thinking this long lease is allowed.
Which
That's why I have to check it to be sure.
Ma, but what about the, I think the cost of long lease
so
is
it's
in nature.
disallowable expenses.
Because it is long lease, right?
Yes.
The one that is allowed is renewal of short
Uh-huh.
list that is allowed.
I don't know if that is allowed, so it kind of confused me.
It's the short one that is allowed.
Okay, so that's it. Let's look at that's even all the information given to us. Then let's total it up. Total. I'm putting a minus because we're lessing it.
This cost of defending a tax appeal,
Yes,
It's disallowable expenses.
yes, it is allowed. So what else do we have? Let's go check before we go on. Dividend. So we have to less non-taxable income. Non-taxable income, we have dividend. Because it was gross that was added, we are going to less what gross. We less what was added there. Move your lecture.
Is it the gross or the net?
No, it's gross because in this case, it is the
Yeah.
amount that was added as income that you would deduct.
Okay.
Okay. So I think that's all.
Is it not add back? Disallowable expenses. Are we subtracting it?
Oh, we are adding no, we are less. Sorry, less. Let me write it there.
So the
This one we are
disallowed.
talking about. Sorry, we are adding back. Thank you for that. I had to lie. So then what do we have? This becomes our adjusted profits. But because we have no previous loss relief, it also becomes our accessible profit. So we have capital allowance. Capital allowance.
Ma, please, can you recap what you said?
Yeah.
Can you say what you said? You said it's due to also be our adjusted profit, but because
Okay. Because there is no loss relief, adjusted profit, when you less loss relief, accessible profit, when you less capital allowance, chargeable profits. So in the ICANN pack, they refer to adjusted profit as accessible profit, like they use it interchangeably. But how I was taught is, adjusted profit first. When you less loss, you get accessible profit. When you less capital allowance, you get chargeable profit.
Yes, does it.
Mm. So capital allowance brought forward for 20. Let us do capital allowance for 2021 first to see if there's any balance brought forward that will come for 2022. Oh my God. For the year. The restriction, they cannot be let me hear what they cannot be restricted because this figure is small compared to the accessible profit. So the restriction probably would not work. So let's just remove it straight away. Please give me a minute. Let me go and look for somebody to carry this baby. All right, sorry. Not even see anybody, sir. Okay, let's continue, please. So we are relieving everything. Balance carried down is going to be 0. Balance carried down. So balance carried down is 0. If I'm writing, so zero. Okay. So then we are going to have our chargeable profits. So now let's go to the question. Let's go to the question. Remember that this what's it called? In doing this question, small company is 25 million below, medium 25 to 100 million, large 100 to 100 above. Sha. So when this company first started, their turnover was 87 million. Which category of company does Shadi Adu fall into in this first year?
Please come again the question.
So I'm saying that which category of company does Shadi Adu fall into, medium company, large company, or small company?
Large
Large
company.
company. Large company. Are you guys sure?
Yes, ma'am.
Yes, based on gross turnover.
For the 2 years?
Yes, ma'am.
No, check where. What is the gross
The
turnover for?
second year does not fall into the large company. It's a small company.
So this which year falls into being a large company?
2021.
2021. So 2020 is it a large company?
No,
What category does it fall in 2020?
medium company or small company.
That's what I want to hear. Medium company. As at this particular year, medium company is 25 million to 100 million turnover. So what is the tax percentage for medium company and tax percentage for large company?
Large company is 30%. Medium company 25%.
25K.
20%, ma'am.
Me call him 25. Okay. So, but for this one, it's going to be 20% multiplied by 13. 4, 7, 5, 3. Okay. So equals to 20%. Equals to 30% multiplied by. Okay. So for the 2 years, I think TET is still 2%, not 2.5, 2%. So we have 2% of the what accessible profit. 25,301,242. Come on. I'm intentionally writing it out too. So that I don't know who was asking question about soft found. The person want to remove my neck on the group. Okay. So the total tax liability will be the addition of these two. So guys, quick question. Are we computing minimum tax for Shadi Adu? Are we computing minimum tax?
No,
No, ma'am.
Why?
no, because
They
the
are
company
less
is not
than
up to
4
4
years.
years.
Eh?
Company is not into 4 years. It's not up to 4 years after incorporation.
All right, that's correct. Okay, so that's all. I guess this will be our last question for CIT. You guys should go and read more on what on CIT. Any question before we move
Very
to
good.
capital gain tax?
Yes.
So,
Very
Evans,
good.
can you spell the answer
Yeah.
again, please?
Can I what?
Can you scroll the solution downward a little bit?
Downward, abi upward.
Yeah.
Okay, now I have a question. I have few questions.
Okay.
So for us to be able to know if the company is either small, medium, or large, are we using gross turnover as a parameter to check?
Yes, it is the turnover. Turnover, the sales or revenue. That's what you are going to check.
Okay, turnover or revenue?
Yes, turnover is the same thing as
As
revenue.
revenue, yeah.
Yeah.
Okay,
So that's what you check.
okay. Is taxable profit same as chargeable profit?
Yes.
Okay, so why didn't you restrict the capital allowance? I don't know. I just keep getting confused in that aspect.
So we can restrict that. I was saying that I intentionally skipped it because the restriction is going to be higher.
Okay.
It's going to be higher because see this figure 2 million compare 2 million to this, and that's like 2/3. 2/3 of this is surely going to be higher than 2 million. That's why I decided to leave it.
Okay.
So
Thank you.
you can just write it in your notes. It does not matter.
Okay, thank you.
You're welcome. Any other question? So can we move to capital gains tax?
Yes, ma'am.
Okay, let's move.
This is a question. No, sorry for coming in late. So if the
Okay.
company is not up to 4 years, you shouldn't compute minimum tax.
Yes, a company that is less than 4 years is not required to pay minimum tax. So they give you a grace of whether you're a big company or a small company, as long as you're below 4 years of operation, no minimum tax for you.
Thank you.
You're welcome. Okay.
Please, the solution for 2022 capital allowance, please.
The solution. This is the capital allowance. So capital gains tax. Please, are we true? Can I back this Excel or can I remove it?
Hello, I have a question, man.
Okay. Oh,
On that minimum tax computation.
okay.
I think when there is no chargeable profit, I think that is the basis for calculating minimum tax or what?
No. So you calculate minimum tax when number one, of course, if there's no profit.
Profit, one.
Then number two, you automatically calculate minimum tax for every company that is more than 4 years because, like the word alludes, minimum tax. That is the minimum tax that they will pay.
It's less
If
than
their
4.
actual tax is lower than minimum tax, then they will pay the minimum tax.
Okay. Okay, so it's only those companies that is less than 4 years.
Companies that is less than 4 years, we will not pay minimum tax. They are not
Okay.
required to pay minimum tax because the government want them to grow.
Okay. So
No
it is those that is higher, I mean, more than 4 years that we can calculate minimum.
minimum tax for years. So
Oh,
assuming this company is more than 4 years now, we will calculate minimum tax. We will now compare between
okay.
CIT and minimum tax, which one is higher. We'll
Yeah.
pick the higher of the two.
Okay. Okay. Thank you.
You're
Thank you.
welcome. Okay, so capital gains tax now. In company income tax, profit or loss on disposal of fixed assets are disallowed income and expenses, right? Also, balancing adjustments is made when there's a sales of assets in capital allowance. It could be balancing allowance, that is when there's a loss, or balancing charge when there's profit, Abby. But balancing charge, this place is charge. I don't know why I omitted charge. Balancing charge is usually restricted to the total amount of capital allowance previously granted on the assets. What I just read, I hope everybody understands because I discussed it at length when we were discussing capital allowance. So when we are balancing charge from the sales of an asset, we restrict the balancing charge to the total amount of capital allowance that you have enjoyed on that asset before. I think we've talked about that. So this means that there is still an amount that is left untaxed, which is the difference between the original cost of the asset and the sales proceeds of the asset. For example, let's take an example. So it's going to be more realistic in our front. An asset costs 10,000 naira and it was sold for 20,000 naira. Tax written down value as at the time of sale is 5,000 naira. Now, let's calculate our balancing charge. Balancing charge is 15,000 naira. How did you get 15,000 naira? 20,000 naira, which is the sales proceed, minus the tax written down value. Abi? Now, we need to restrict this balancing charge to 15,000 or 15,000 to 5,000 because the total capital allowance that was previously claimed on the asset is 5,000. So we reduce 15K to 5K. So when we are computing CIT, balancing charge will be 5K instead of 15,000. Now, the excess gain on the asset is what CGT takes care of. That is sales proceed less cost, the 20K minus the what? The 10K. This is just like a succinct, because some people get confused that maybe we are calculating balancing charge. Why are we doing CGT again? This is like a mini differentiation between balancing charge and what capital gains tax. Now, capital gains from the sales of capital assets are subjected to capital gains tax. Administration. FIRS is to administer for corporate bodies and non-resident individual, that is individual outside Nigeria, while for individual, except non-resident and resident of the Federal Capital Territory, it is administered by the State Board of Internal Revenue. So the FCTIRS administers CGT with respect to individuals in Abuja, in FCT. Yes. So let me say this again. It is the FIRS, that is the Nigeria Revenue Service, NRS. NRS is the one that collects CGT for corporate bodies. So if companies or non-resident individual, if they sell their asset and they have gain and they have to pay CGT, it is FIRS that they will pay for. They will pay to, sorry, or NRS. But when we're talking about non-corporate body, like individuals, like sole proprietors, partners, you know, PIC people, then it is the state IRS that will collect their what? CGT. Let's move on. So capital gains, what do you refer to as capital gain? It is, please, that person should mute this or mic. Oh. Capital gains is defined as gains arising from increase in market value of capital assets to a corporate body or person that does not arbitrarily offer them for sale and in whose hand they do not constitute stock in trade. Let's talk about that. So we expect that for you to make a gains from the sales of your assets, it means that the market value of the assets has increased, right? Because of course, when you bought the assets, you bought it at a particular amount and it has even depreciated, but still you are able to sell it at a gain. It means that the market value of the asset has what increased. But for us to consider a particular profit as a capital gains, it means that that particular asset that you sold is not what you usually sell for sale. It is not your normal goods that you sell for sale, and it does not constitute inventory in your hand. Let me take a realistic example. For some company, motor vehicle is asset, while for some company, motor vehicle is inventory, is their normal purchase and sale. That is what they sell. For company that sell motor vehicle, if they should sell a car, it does not form capital gains. Rather, it is a profit on what? On sales. It's their normal profits. Okay. But for companies, for example, a bread factory that have car that they use to distribute their bread, if they should sell that car and they get gain on that car, it's capital gain because their normal inventory that they sell is bread and not car. Do you get it? So in the bakery's hand, the car is not an inventory. Neither is it their normal sales assets or something like that. Sha. So now capital gains is the difference between the sales proceed and the sum excluded from sales proceed, being cost and auxiliary costs of disposal of a capital asset. Okay, so it's just the difference between your sales proceed and the cost of the asset and all the money that you expended while trying to sell the assets. It's also you're going to remove it. One guiding principle is to examine the purpose for which an asset is bought or sold. Where an asset is acquired for use or as an investment, proceed on the disposal of such assets is capital receipts, and any gain will be regarded as capital gain. I've explained that before. On the other hand, where fixed assets are kept and sold regularly for gains, that is profits, such disposal will be treated as normal income receipt and tax under PITA or SITA. I've also explained that. CGT is imposed on gains arising from ownership of a capital asset changing hands either by exchange, by transfer, by sales, or by gifts. The Act is presently silent on gains arising from appreciation in value of an asset, which has not changed hands over time. So what this one is saying is that, for example, share. When you buy shares now, or you buy a car, and the car increase in value, like you know that the value of this car has increased, though you have not sold it. So they are not telling you that the Act is silent on what will happen to that kind of gain, though it's a notional gain because you can't say you've gained anything until you sold that particular asset. That's my personal opinion. That's not what the Act said. I'm just saying my personal opinion that it's stupid to tax such gain in the first place because until you sell the asset, you have not actually gained anything. That's my own opinion. So now, but the Act does not even say anything about it. So it's like an ignorable stuff. Capital gain tax is chargeable on the total amount of chargeable gains after deducting allowable expenses on the disposal of chargeable assets in the year of assessment. CGT is on actual year basis. Let's move. Now, allowable expenditure. No, when you sell or when you even before we talk about sell, when you buy the asset, you might have spent some money to ensure that the asset is working well, to put the asset in the good condition for working, right? Or you want to sell it and you need to put it in a good condition for sales. All those things are expenses. Now, if you now want to sell, you might even incur some additional expenses. Maybe you needed to get a broker, or you needed to get a middleman to help you find somebody that will buy the assets, and you have to pay the person, you have to pay for legal work, and so on and so forth. Those things are expenses, and you have to consider them. So these are the list of allowable expenditure. Number one, cost of acquiring the assets. So now when they say purchase price or acquisition cost, it includes all costs incidental to purchase. IS 16 PPE. I think you've done that, and you should know all costs that are incidental to purchase. And you guys are professional now. Why am I speaking to you guys as if you are skills people? You are professional. You guys are should I say accountants. So number one should not cause any issue. Number two, improvement cost rarely incurred. So when I say improvement cost, you want to sell it and you need to, for example, if you want to sell a house and you know that the plumbing in the house is not okay, you need to fix the plumbing, right? So those things are improvement cost. Cost rarely incurred in establishing, reserving, or defending the owner's title or a right over the assets. Now, if for example what you want to sell is land, for land, the documents that you have is very important. So you decide to collect C of O so that you'll be able to charge a higher price on the land. So for you to get C of O, you need to incur money. C of O is you defending your title to the land, and that kind of cost is allowable. Incidental cost of disposal. Now they decide to give you examples of incidental cost of disposal. We have the fees, commission, and remuneration paid for professional service of valuer or surveyor or auctioneer or accountant or agent or legal advisor. Any of these people, if you seek their service and you paid for them because of that particular asset, is allowed. You are allowed to remove the expenses. Cost of transfer or conveyance, including stamp duty, is allowed. Advertisement to find seller or buyer is allowed. Cost reasonably incurred to make valuation or apportionment required for the purpose of computing capital gains is allowed. So now disallowable expenditure, number one, any sum allowed in computing profit or gains for income tax are not allowable. Let me explain that. What we are trying to say here is that as long as CIT that we just finished, that Shade Adu CIT, as long as that expenses is allowable under CIT, it is disallowable under CGT. Let me repeat myself. As long as that expenses is allowable under CIT, it is disallowable under CGT. Because if we allow it under CGT, it means that we allow it in two different places, and you are absconding with our money. Yeah? Number two, insurance premium on the assets are not allowable. Now, rate of tax and date of payment of tax due. CGT is chargeable as 10% of capital gains. Before I forget, please, I intend to say this before we start the class, but I forgot. So, everybody, CGT comes out every diet. CGT will always appear every diet. And I always advise my students to please attempt CGT, except if you know that in your heart of heart you don't understand it. There are some people that they don't used to lie to themselves, and I like that. I like those kind of people. If you don't know it, you face reality and know that you don't know it. You get it. But CGT is very simple. That's why as I'm teaching this topic, I want us to ask questions if you don't understand. I want us to it's bonus question. It's bonus. It always come out. It's sure, number one, it's sure that it will come out. There can be traps, but if you understand CGT, you'll be able to identify the trap and you will evade that trap definitely. The first question that I always attempt, like before I wrote my exam, whenever I'm trying to ask question, is CGT. And when I started my exam, the exam of CGT Mobokoshi, it's bonus question. I don't have to think like CIT or any other question, like it's easy, right? So pay attention, please. CGT is bonus question. It is like easy mark. If you have question, in fact, ask it 10 times. I don't mind. I will answer you. Okay. So the rate for CGT is 10% on capital gains arising from disposal of assets. So if you get your capital gains, you just multiply by 10%. In line with the other Financial 2020, Every person having disposed a chargeable asset shall not later than the 30 June and 31st December of that year compute capital gain, file set assessment, pay the tax computed in respect of chargeable asset disposed in the period. So let us explain the jargons that we just said. Any asset that you sell between January to June, capital gains must be paid in June 30 or not before June 30. Any asset that you sell from July to December will be paid in what December. So if you see a question and they're asking you when should they pay the capital gain that you have calculated, look at when did they sell the asset. Did it fall between January to June? If it falls between January to June, then they are expected to pay not later than June 30. But if it falls between July to December, they are expected to pay not later than what? December 31st of that year. Remember, CGT is what? Actual year basis. The profits or the gains, the tax on the gain for that year will be paid in that particular year. Can it be next year? Oh, it's not PYB, but what? AYB. Clock that. Computation of chargeable gains. How do you compute your chargeable gains now? The Section 3 of CGT Act defines chargeable gain as all forms of property. Sorry, chargeable assets, not chargeable gain, sorry. Chargeable assets as all forms of property, whether situated in Nigeria or not, and it includes options, debt, and incorporeal property, any currency other than Nigeria currency, any form of property created by the person disposing it, otherwise coming to be owned without being acquired. Stocks and shares of every descriptions. All of these form was chargeable assets, which means that if you sell any of these things, you're going to be charged CGT. Now, Section 4 provides that where disposal of assets is by an individual who, number one, who is in Nigeria for temporary purpose only and not with any view or intent to establish his residence in Nigeria, if the period or sum of period for which he is present in Nigeria exceed 182 days. Let me see if there's more. Where the disposal is by any these people are shouting. Where the disposal is by any trustee of any trust or settlement, and the seat of administration of trust or settlement is situated outside Nigeria during the whole year. Where the disposal is by non-Nigerian company, whose activity are managed in the year of assessment. Okay, let me first explain before we move on. Now, we want to talk about the disposal of an asset in situation where the person disposing the asset is not in Nigeria. Like, let's say, let me start from number one. The person is in Nigeria, but only temporarily. He does not intend to stay in Nigeria. He disposed an asset, but is not currently a resident. Like, he's not a Nigerian resident. He's only in Nigeria for a limited and very short period of time. Number two, the person is present in Nigeria and his stay has exceeded 182 days, which means he has become a resident. Abi? Number three, the disposal is by a trustee. I believe we all know who a trustee is, right? And the trustee is not in Nigeria. The trustee is not in Nigeria for that particular year of assessment. And the last one is where the disposal is done by a non-Nigerian company. A non-Nigerian company. So CGT shall be taxed on that part of the gain received or brought into Nigeria when they are so dealt with. This is what is called remittance basis. The amount of gains chargeable is dependent on the whole or part which is remitted to Nigeria. If there is no remittance to Nigeria, there is no liability to CGT in respect of disposal of those assets. So, regarding all of these people, all of these four people that we mentioned above, the only tax that we are going to charge them on is the amount of money that they bring into Nigeria from that particular gain. If they sold the asset outside Nigeria, as long as the money did not enter Nigeria, we are not expected to tax them. So, but if they received the money in Nigeria, we tax them on the amount received. If they received it outside Nigeria, but brought the money into Nigeria, as long as the money have entered Nigeria, we are going to tax it. I think the only thing that prevents them from taxing, I think, is if you keep it in a domiciliary account in a bank that is recognized by CBN. I think so. But the moment you remove the money from the domiciliary account, they are waiting for you. They will tax it. So I think some question is to ask. They will ask you that as a tax consultant, you should advise the person selling the asset. How can he reduce his tax liability? So one of the ways of reducing is to tell the person to keep it in a domiciliary account. But as usual, you cannot keep the money forever. One day you shall remove the money. You meant to remove the money, you pay tax on that money. Okay? So now let's move. Finance Act 2023 provides that number one, in computation of chargeable gains under this act, the amount of any loss that accrues to a person on disposal of any asset shall be deductible from gains accruing to the person disposing that asset, provided that such loss shall only be deductible against the same type of asset. So this law came into place after I wrote my exam. So I've never actually practicalized this particular rule. I've not practicalized it, like whether in exam setting or um reality. Okay, I've never even paid CGT before. Actually, in reality, my firm, I've never handled such an assignment. But what this one is saying is that just like under CIT, that you are allowed to relieve your loss, CGT now allow you to relieve loss on assets. Let me give a realistic example. Let's say Faiz company, my company is Faiz Variety Store, and I have a car that I used to distribute people that to my customers, people that buy goods, like a logistic, I distribute it to them. So if I should sell that car and I incur loss, CGT is only chargeable on gains, right? So they're not saying that if I incur loss, I can decide to keep the loss until I sell another car. I have a gain, then I'll now relieve that loss from the gain of that car. It has to be the same asset, the same type of asset. I cannot incur loss on car, and when I sell, let's say, what can I sell again? When I sell one building, I be one land, and I say I want to relieve the loss of motor on the land. It's not possible. It has to be the same type of asset. Okay. So when you now sell the same type of assets in the future, you are going to relieve the loss that you made in the past from that particular gain. Now, two is saying that the aggregate of capital loss by a taxable person in a year exceeds the chargeable gain. Where the loss exceeds the gain, the loss can be carried forward to deduct from chargeable gains arising in the future from the same type of asset, provided that that loss would only be carried forward for a maximum of 5 years immediately succeeding the year in which the loss was incurred. So it means that after selling the second motor, if my loss is still higher than the gain, I can still carry forward the loss until I sell another car, as long as the loss will not exceed 5 years. Um moment we are already 5 years after the loss first happened, then we have to let go. Terminal loss as a call. We let go of the loss. That means it is no longer what relievable. I don't know if it's English like relievable. You can no longer relieve the loss. So it means that after 5 years on CGT now will not normal CIT. For normal CIT, you can relieve loss for as long as you want. For CGT, is a maximum of what? 5 years. You cannot relieve loss for more than 5 years. Guys, are we still together? So exemptions from capital gains. There are some gains that are exempted. I only
So, can anybody hear her? I've lost her audio voice.
I guess it's our network.
Hey guys, oh sorry, shame the devil. My Wi-Fi died again after charging it for hours. Shame the devil, but I came prepared. Okay, I guess you guys should be able to see my screen. I came
Yes.
prepared. Thank you. Okay. So I talked about gains from statutory or voluntary trade union. Then gains accruing to any local government council, which means you cannot charge local government council CGT. Gains accruing to a company. All this one, please go and read it. Let us waste time on reading all this gains. But one thing that I would like you to like, I want to take attention to this one. Yes, number 8. Gains accruing on disposal of land compulsorily acquired by an authority having and exercise such power. So this one is like, government wants to build road and they force you to sell your land. It's not like you want to sell your land. Local governments need your land for a particular project, and it's important that it is that land that they must use. They now force you to come and what? To come and sell your land to them. In that instance, even if you have a gain on that particular sales of land, even if you get gains from that particular land, it's not chargeable because you had no intention to sell it. You were forced to sell it, right? And the person that forced you is not somebody you can say no to, is the government, an authority like local government, state government, FG. Somebody you cannot say no to. Okay. Then gains accruing in connection with the disposal of an interest or right under policy of insurance or contract for the fraternity. Okay. So other exemptions or relief in the Act, we have it exempts some acquired by compensation or damages for any wrong or injury suffered for an individual in his profession or vocation. So if you get injured, maybe injury for libel, slander, or enticement, some obtained for loss of office exceeding 10,000 is chargeable. So if the money is more than 10,000, when you lose your note, sometimes if companies send you away without prior notice or without you doing anything bad, they have to pay you money, right? Compensation. So if it should exceed 10,000 naira, I thought this money was increased. This is what I saw in the paper. If it exceeds 10,000 naira, the excess will be charged to CGT. Then gains accruing on disposal of a dwelling house. The dwelling house that has been the individual's main residence throughout the period of ownership. So it's like I'm living in my particular house, in my own house, and I decide to sell my house. So the gain is exempted. But you have a maximum land area. I've never seen a question that covers this shall. Okay. So if the individual have 2 or more residents, then you have to determine which of the 2 residents is the principal resident, whether the one that was sold is the principal resident or not. Then the person will have to write to the revenue service within 2 years to you shall tell them which of the 2 or which of the residences is the principal residence. Then let me see. All of these ones you can read. Asset acquired by way of gift and disposed of in a similar manner. So if they gift you and you gift back, if they gift you and you sell, it's gain. It's gain. If you were gifted a car and you sell the car, because when they gift you the car will surely have a value. The cost is the value of that car as at the time when you were gifted the car. Then you now sell the car, you get gain. It's going to be chargeable to CGT. But you were gifted the car, you also give somebody else exempted, right? Okay. So I think the others are things that you can. And here I know that this thing was increased. Compensation for loss of office below 10 million is now exempt. Not before it was 10,000. You read the one that was here, 10,000. So it's now 10 million because 10,000 is ridiculous. It's ridiculous. So if your compensation for loss of office is above 10 million, The excess above 10 million will be taxed. Now, disposal and acquisition of assets. What do you mean by disposal? When does the
Quick one,
tax?
ma.
Eh?
Quick one, ma. Based on, I think there is something regarding double taxation relief as to capital gain tax. So how does that work, ma?
Since we just skipped it, I saw it, but I was
Number
um
seven, number seven, number seven,
yeah,
number seven. Yeah.
number okay. Double taxation relief is applicable to CGT as it is applicable to income tax under PITA and SITA. This one will be dependent on this DTA between your country and the country that that you probably sold the asset in. So it depends on the law between you guys, between Nigeria and let's say London, between Nigeria and which other country, any other country, sha. So but they're just telling you that just as we have DTA under Peter and Sita, we also have under CGT. And the rule that is under Peter and Sita is that we follow the agreement between the two countries or between the three countries, whatever it could be, multilateral or unilateral. Do you get? So there's no one single rule. We have to do DTA, but I'm not sure it's in the pack. I did not see it in the pack. I plan to probably this week. I'll have to go back and be sure because the CGT is not in the topics that I wrote down, which is very surprising. But I'll check through again and see. I want to be sure. Okay. So now, meaning of disposal. According to the Act, there is a disposal of assets by a person where any capital sum is derived from sale, lease, transfer, assignment, compulsory acquisition, or other disposition of assets, notwithstanding that no asset is acquired by the person paying the capital sum, and in particular, let's read this one by one and explain. But before we read, let's talk about what we just read. When do you say someone has disposed an asset? Number one is when you get a capital sum. That is a capital when I believe we understand the word capital sum. Owó tó pọ̀ dáadáa. It's not one petty money, like a capital amount. You receive that particular capital amount. And why did you receive it? It could be from a sale, you leased, you transferred, you got assigned, acquisition, and so on and so forth. And now they wrote something there that regardless of whether you acquire an asset, the person that pay you the money might not have acquired any asset. That is, the person might not have collected any money from any asset from you, despite the fact that the person paid you money. Now let's read. Number one, where any capital sum is derived by way of compensation for loss of office. I think we've talked about this before. When your company decides to fire you without any reason, they pay you money, right? That is disposal. Where capital sum is derived under policy of insurance, you insured your goods, you got bond, and they gave you money. Is what? Disposal. Where any capital sum is received in return for forfeiture or surrender of assets from refraining from exercising rights. This one, I think you guys should have done it in what's it called? What's this? I've forgotten the topic. If you want to buy shares, I mean you want to merge or acquire, and you do share for share, something like that. Sometimes you do share for share. The shareholders you collect share in the new company. Sometimes you pay the shareholder off, right? Something like if you now pay the shareholders off, you want them to surrender their rights. Something like that is also what is disposal, and you have received the capital sum. Where capital sum is received as consideration for use or exploitation of assets. So you want to use your assets, and you give them the go ahead to use it for a particular amount. Where capital sum is received in connection of any trade or business. So you can sell your business. You can sell your business or your trade. So if you sell and you receive that money, it's also what's disposal, right? You can also have part disposal. We talk about part disposal later. So when you say an acquisition or a disposal is effective, now a disposal or acquisition takes effect on the date of the contract to acquire or dispose the asset. or on a date at which there is an enforceable right to acquire or a binding duty to dispose the assets or any interest. And in particular, before we read that one, so we have number one, you can have a disposal or an acquisition when you actually dispose or acquire the assets. If I should go to the market this evening like this, as I'm doing this class, I can go to one place and say I want to buy a car. God have blessed me. I want to buy a car. At this particular moment, I've acquired the assets, right? And if assuming I have a car, and at this particular moment, I say I want to sell my car, and I find somebody to sell it, I've disposed it. That's the actual date, right? But then in some circumstance, you just don't dispose it outrightly. It becomes enforceable. Which example can I give? Situations where at a particular date you are forced to sell your assets. You know those people that people just come and say that they are the owner of their land. Is that you pay them money or you leave the land? It happened with my parents. It was very sad, right? They were like 12, and somebody just came and said he's the owner of all of our land, and we have to pay back the person.
Your money.
Yeah,
I said your money less.
exactly, something like that. They'll just come and say they hold, and the man came with titles that cannot be, how can I say it, that cannot be refuted. And it was so funny because that land is as old, because we have to pay, we are still there. That land is as old as me. My daddy bought that land the year he gave birth to me. And as at that particular moment, I was like 18. And in my head, I was like, where has this man been for 18 years that he just now come out of nowhere to claim a land that's been owned for 18 years? But the thing is that he has titles. He has everything to claim all of our lands. Not one person, like 15 people. He had everything to claim that land. I don't know how he did it, but he had everything. Now, he gave an ultimatum. This particular date, either you agree to pay me back instrumentally or you leave. The moment that day comes, let's say for example January, the moment January comes, according to the tax authority, you have disposed your land, because as at that particular moment, you do not have right to that land again. No. You don't have right to the land again. Definitely the land is gone. You get? So is that the date that you actually do that thing, or the date that you are binded to do it? One of the two. I mean the earlier of the two then. So where any contract to be performed subject to condition, that is, there's a condition, the date of acquisition or disposal shall be the date when the condition is satisfied. But where a consideration of the contract does not depend on the value of the assets at the time the condition is satisfied, the disposal shall be treated as if the contract have never been conditional, in which case effective date shall be the date of the contract. Now, this one has two things embedded in it. Number one, if there's any condition to be satisfied. If there's condition to be satisfied, then the date of disposal or acquisition shall be the date when you satisfy the condition. But if the money that you will pay or you will receive, that is the consideration for that contract, does not depend on the value of the assets at the time when the condition is satisfied, you get, then as at that particular time now, like that particular condition now, means that disposal or acquisition will be the date of the contract. That is the date when you and the person enter contract, and no longer when the condition is satisfied. So number two is saying where an option is conferred by virtue of any contract, the date of acquisition and disposal shall be the date when the option is exercised. So we all know what option is now. We've done it in what's it called? Oh, I might forget the name of this course. This strategic what's the name of this course? I forgot it, Sha.
SFM.
SFM. You've done an option in SFM. So until you exercise your option, then you will not be seen as if you have acquired or you disposed the contract. Now, hire purchase. Where a fixed asset is purchased under hire purchase, the cost for tax purpose is the cash price of the asset, which means we are not considering the hire purchase price. Remember, the hire purchase price equals to cash price plus what? Interest. So because you are not paying at the time when you have to pay, you will pay interest on the time that you have wasted, right? But in this case, you do not consider cash price. Sorry, you do not consider higher purchase price, you consider cash price. Okay. So the higher purchase charges, which represent interest charge, are allowable deductions under SITA in arriving at assessable profit. Thus, for capital gain tax purpose, if all installments have been paid before the date of disposal, it is the full cash price that is taken as cost for capital gain purpose. If installments have not been fully paid, the cost of the asset at the time of disposal will be the cash price portion of the installment paid to the date of the disposal. This thing is explanatory, but let me repeat it. Number one, when you sold that asset, you have paid all your higher purchase money. You have paid everything. It means that the cost of the asset will be the actual cost, that is the cash price cost of the asset. But in case where you are still paying the money, when the you are still paying money, but you have sold the assets. It sounds funny, but it can be like that actually. But you are still paying the money. So what you're not going to prorate. The portion that you have paid is the portion that you will pay CGT on, something like that. They're going to prorate it. There's calculation on this thing, and the calculation is very crazy. I don't even think I have a question on it. So you pay CGT on the portion that you have paid. I mean, the portion of installment that you have paid. Let's say, for example, you have paid 60% of the money, so you only consider 60% of the cost of the asset. You get. So, bargains comprising two or more transactions. Where a bargain comprises two or more transactions, then the assets are disposed of. Those transactions shall be treated for the purpose of computing capital gains as a single disposal. Where separate considerations are agreed or purported to be agreed for any two more transactions contained in one bargain, this consideration shall be treated altogether, constituting an entire consideration of the transaction, and shall be apportionable between them accordingly. So now you have one bargain, but in that bargain, what you are collecting or disposing is more than one. Okay, let's say for example, just like you used to go to the market and you say, don't price one, pack everything together and price together. You know that if you price it one by one, everything costs like 30K. You now say, madam, let me pack everything 35K. You know that kind of thing. Even though it's one single bargain, but what you're buying is more than one thing. No? So for tax purposes, I'm not supposed to use clothes because clothes is not CGT. Let's say car. You go to a car dealer now and you want to buy like 3 cars. Imagine buying 3 cars. You will be doing Igara. Just say, instead of paying like, let's say 50 billion for the car, say, sir, reduce like 1 million for me from this thing. I'm buying 3. It's a bargain, but you are getting more than one asset, right? More than one transaction. So now you are going to see that particular transaction as a single bargain. You treat it as if it's just one transaction that you did, right? Just one transaction. Then if the price that you agree is different, even though you bought at once, but they not say that no, I cannot agree that one. There are 3 different things. Price them one by one. That is, you bought everything at once. Then you are going to consider the consideration together. You add them together to what? You add them together to know the price of the single bargain. And if you want to know for each one, maybe you paid all together. You want to know the price for each of the assets, then you divide by the number of assets. Where any apportionment results in lesser consideration than agreed in the bargain attributable to the disposal of the asset, separate consideration agreed in respect of those assets shall be deemed to be consideration of which those assets are disposed of. These people, they are thieves. So what they are saying here is that, you paid for the bargain. Let's say you paid for the 3 car instead of 50 billion. The person decided to remove 1 million for you, right? Or how can I explain this? Okay, let's do it that way. 50 billion, remove 1 million. So if you now remove 1 million, I don't want to call the figure that will remain because I know that it will remove my teeth. You divide that remaining figure by 3. If you divide it by 3, maybe because of approximation, rounding error, and you add it back, it will no longer give you the amount it's supposed to give you. Then don't divide it. Use it as a whole figure like that. tax it as the whole figure like that. That's what they're trying to tell you. Moment it will result to a lesser consideration, that is, the money will reduce. Don't divide it. Use it as a whole. Okay. Partial or part disposal. Where there is part disposal, the cost of that part of asset disposed and that of the undisposed part shall be apportioned. The value of the whole asset on transaction date, that is on the date at which you sold the part of the asset, is the consideration received in respect of the part disposed plus market value of the part undisposed. Now, if A is the consideration received for the part disposed, B is the market value of the undisposed part, C is the cost of the whole asset, then what we are trying to calculate here is the cost of the part that was disposed. Let me take a realistic example. You have a land, you bought 1 plot or 2 plots of land, then you built your house. After building the house, you saw that you only built your house on 1 plot. Even if the 1 plot still has what's it called? Compound itself. Fire to land now. Even that 1 plot is still even that 1 plot still have compound. You not be like, instead of wasting this remaining 1 plot, let me sell it. You know that when you bought the land, you bought 2 plots together. You bought 2 plots together, and you built your house on one plot. Now that you want to, sorry. Now that you want to sell 1 plot out of the 2 plots, how do you know the cost of the 1 plot? Now, number 1, A is what? The cost at which you want to sell the 1 plot. B is the market value of the part that you don't want to sell. That is, if you sell the 1 plot, assuming you want to sell the remaining 1 plot that you built your house on, what is the market value? Then C is the original amount that you paid in respect of the whole asset. Then when you use this formula, A over A plus B multiplied by C, it will give you the cost of the parts disposed. When we are doing calculation, you understand this part better. Yeah, come. Stop shouting. Let us do our class. Thank you. All right, connected persons. I think we should understand what connected person is. But Broza would have taught you guys. Okay. So in tax practice, certain persons are treated as so closely involved with each other that they are viewed as the same person, or that transaction between them needs to be treated differently from those at arm's length. Those persons are referred to as connected persons. Transaction between such persons may be regarded as artificial or fictitious for the purpose of determining the tax. This implies that the revenue can take whatever adjustment as is considered necessary to counteract the reduction of liability to tax that could result from the transaction. So, if a connected person, the revenue will be looking at you. They want to know what you are going to do with each other. Are you going to be reducing price unnecessarily or increasing price unnecessarily to reduce or increase your tax liability? Where the person that acquires an asset and the person that disposes the asset are connected, the person shall be treated as parties to a transaction made under arm's length transaction. This implies that the revenue will make whatever adjustment necessary to counteract what we read before. What we are trying to say, let me just say it in simple layman terms. I and let's say Ify, we know each other, right? Let's say Ify is my sister and she saw my car. Even though I'm using the car for business, so she might feel like this your car is very good, though, and she would also need it for her own business. And she feel like I have more than 1 car. I should send one car to her. If it's my sister, if the car is worth 1 million, I can decide to sell it to Ify 800,000. You know the reason why I sold 800,000 is because Ify is my sister, right? If it had been somebody else, I would have sold 1 million. The tax authority is not telling you that. They did not ask you to do Ojoano. Neither did they ask you to sell the asset to your sister. They don't know your sister before. And if you could not do it at arm's length, they will help you to do it at arm's length. As they have sold for 800,000, tax authority will help you to revert the money to 1 million, and 1 million will consider the state's profit, even though you did not receive 1 million. Please, guys, I want us to understand this because I think I've seen a question that consider this. Do you understand what I'm trying to say? If you sell below the normal value of the assets to a connected person, tax authority will ignore the amount achieved at which you have sold that asset and will use the original cost of the asset to compute your own liability.
You are muted, oh.
I can't see anything.
Maybe we've lost her. Maybe we've lost her again.
Kudus, you can continue from where she stopped now. Thank you, sir.
There is no material to explain.
Scholar like you, sir, you don't need material.
So good evening, guys. So she called me. She said her Wi-Fi is not coming up. That she will upload the material today, and we can go through the written aspect while we start the calculation aspects this class in the next class. Please, can everybody hear me? Okay.
Yes, we can.
Yes,
So
yes.
can we leave the call now?
Yes, I think we can. She is not coming back online.
Thank you.
Thank you.
Everyone left the call already. I've been able to connect, so but everyone left already. No problem. You guys will meet next
We are still
Monday.
here. Oh. We are here. We are here.
It's just the two of us. I cannot teach two people now. Just
Okay. Please
I
help us upload
I
the
will
stuff on
upload it
Drive.
now.
Yes.
I still I don't know how to operate the MiFi and it's giving me issue. I've read the paper, I still don't understand the thing. Oh, no problem. Okay,
Okay.
thank you. Let me stop recording first.